Hello, welcome to the Speculation Lab. This time, we're not going to talk about trading strategies. Instead, we've prepared a comprehensive checklist for a complete trading system for everyone. You can use this as a foundation to build a trading system like a professional trader. So, what's the difference between a trading strategy and a trading system? A trading strategy is a tactic that targets specific instruments, cycles, and market conditions. A trading system, on the other hand, is capable of formulating different trading strategies for various instruments, cycles, and market conditions. That's what qualifies as a system. Next, I'll show you how a complete trading system operates. And all you need to do is smash my subscribe button. To carry out a trade, the process can be divided into three main parts: preparation before trading, execution during trading, and review after trading. Before we dive into a trade, let's talk about the preparation work. Before every trade, we should review the daily, 4-hour, 1-hour, and 15-minute charts for all the instruments we're interested in. This way, we can get a rough idea of the current market condition, the directional bias for the next period, and the potential range of price movement. Based on this analysis, we can decide whether to engage in short-term, mid-term, or long-term trading. For those looking into the latter, it's crucial to pay extra attention to market trends and news dynamics. Next, it's time to jot down our trading plan for the selected instrument. A comprehensive trading plan should detail the rationale for opening positions, the timing for entry, the assessment of probabilities, the position sizing for orders, and the strategy for closing positions. None of these 5 steps should be skipped. Take Bitcoin as an example. After reviewing its charts across various timeframes and using methods like moving averages or wave analysis, we determine that Bitcoin is on an upward trend in its larger cycles. This seems to be a 4-hour level pullback. With the price having fallen close to 30%, we observe that it has now dropped close to the 4-hour Vegas tunnel area. Assuming that the price will stabilize here, we can base our trading plan on this hypothesis. Let's dive into the basis for opening positions. The convergence of the 4-hour Vegas tunnel, the high volume area, and the demand zone creates a triple resistance resonance. When the first 4-hour candlestick enters the Vegas tunnel, we notice a sharp increase in trading volume. This indicates that the resonance of this triple resistance area indeed has a substantial number of orders capable of halting the price's decline. Next, we shift to the 1-hour time frame and observe that the candlestick entering the 4-hour Vegas tunnel, when broken down to the 1-hour level, shows 2 candlesticks with long lower shadows. This suggests a rapid accumulation of bullish orders during the same period, pushing the price up. Continuing on the 1-hour time frame, we see a perfect bullish divergence on the MACD, and the OBV has also started to oscillate and exceed the levels before the decline. These factors together strongly suggest that this area likely contains a concentration of orders sufficient to drive the price up in the short term. Therefore, we decide to follow the big money and enter the market to capitalize on this short-term price movement. The second step is choosing the right moment to enter the market. We could place orders in batches at the upper, middle, and lower sections of the Vegas tunnel, or wait for the 1-hour MACD to show a dotted line, confirming multiple bullish signals, before directly entering the market. The third step involves assessing the probability. For instance, in this trade, we follow the strategy that going with the major trend while against the minor trend, and the naked chart supply and demand, as well as volume indicators, all pointing in one direction. Based on this, we can assign a subjective success rate to the trade. If the probability is high, we might increase our position size accordingly. Conversely, if the probability is low, we'd only test the waters with a smaller position. The fourth step is about position sizing, which is how much of our portfolio we allocate to trades at different entry points. For example, after analyzing the 4-hour time frame, we decide how many contracts to place at the upper, middle, and lower parts of the Vegas tunnel, or how many to purchase at once after multiple bullish signals confirm on the 1-hour chart. Calculate a ratio based on your total capital. For high probability trades, don't hesitate. For low probability ones, be decisive in stepping back. I recommend low-risk trading, where, regardless of the perceived probability, leverage should not exceed 2 to 3 times the total capital. The fifth step is setting exit points, which includes both take profit and stop loss. For stop losses, we can base them on the 4-hour Vegas tunnel, such as below the tunnel, or use the demand zone, or near the area of highest volume at a previous low. Alternatively, a stop loss can be set based on a fixed percentage of the order volume, like deciding to cut losses if they exceed 5%, or implementing a phased, partial stop loss strategy. Another method worth mentioning is called the break-even stop loss. Simply put, once the price breaks through a key resistance area, it creates a new resistance barrier. At this point, the stop loss can be moved up to the entry price, effectively creating a risk-free trade. Take profits can also be executed in batches. For instance, the first target might be set near the 1-hour level Vegas tunnel. The second target could be near a supply zone, or you might decide on a fixed percentage for taking profit, such as being content with a 5% or 10% gain. This covers the preparatory work before trading. Next is the execution phase during the trade, where we can set alerts for key positions on platforms like TradingView. Act according to the plan once the price hits these alerts, like setting an alert for when the price drops below the 144 EMA of the Vegas tunnel. After the alert, proceed to the next step, constantly monitoring the trend to see if it deviates from the initial analysis and whether the trading plan needs adjustment. The process of trading is a continual cycle of hypothesizing, verifying, and adjusting. While the market is unpredictable, we can continually refine our trading system, aiming to make each hypothesis closer to the truth until the price reaches our profit target, thus completing the trade. If the price hits the stop loss first, then the trade ends there. Next, we move into the post-trade review phase. Reviewing trades, documenting the reasons for profits and losses, and optimizing the trading system are crucial tasks. It's essential to understand why each trade resulted in a loss or profit, whether it was expected or a surprise. Conducting a thorough review of the market is the fastest way to grow in the trading field. It's akin to fast-forwarding through someone else's lengthy trading journey. Continually reviewing, summarizing, optimizing, and then revising should become a part of your trading routine. The benefits of this process truly become apparent only after you've experienced it for yourself. This is our systematic approach to trading before, during, and after a trade. Following this framework will, over time, hone your trading intuition. This intuition isn't just a hunch but a skill developed through practice. I believe a trading system is a set of rules that monitors market trends while also restraining human nature. It can provide clear instructions for opening and closing positions based on market changes and calculate the capital and order volume that can be used based on the risk involved. These established rules help to limit the trader's most uncertain feelings. Baseless intuitions are the least reliable. All right, don't forget to hit the subscribe button to stay updated with more profitable trading contents. I wish you a good morning, good afternoon, and good evening. Goodbye.